Okay, good morning everyone. I'm Chris Yu, Head of the Digital Government Unit here at Policy Exchange, and welcome to this morning's event on financing innovation. So with less than a week to go before the Chancellor makes his 2012 budget statement, we organised this event to discuss the challenges for business owners and entrepreneurs seeking finance and growth capital. Earlier this morning, Policy Exchange published a short report examining the financing challenges for early stage, aspirational and growing businesses. And in that report, we argue that policymakers need to move on from a debate that is too skewed around bank lending and think more broadly around the entire funding ladder for growth firms. We think that the government can and should do more on measures that will help startups, business owners and entrepreneurs to focus on going for growth. Amongst other things, the report proposes radical tax simplification for new businesses. Getting this right would mean one less distraction for business owners wanting to execute well and plan for growth. A new ISA allowance for retail bonds. This would encourage an alternative mechanism for small and medium-sized businesses to raise capital. And we also talk about reliefs and schemes to improve incentives for equity investors. And finally, we propose an enterprise kick-off fund to provide loans to young entrepreneurs. This will be led by the private sector with just enough public support to make it viable. And you can download a copy of the report from our website, which is policyexchange.org.uk. Now, this morning is about hearing a range of perspectives on kickstarting British businesses. I'm delighted to welcome a really brilliant array of speakers this morning. With us we have, starting from my left, Nadim Zahari MP, Member of Parliament for Stratford-on-Avon and a member of the Business, Innovation and Skills Select Committee. Along with Matthew Hancock MP, Nadim published the best-selling Masters of Nothing, The Crash and How It Will Happen Again Unless We Understand Human Nature. Before entering Parliament, he was founder and CEO of YouGov, and in 2008 he was named Ernst & Young Entrepreneur of the Year. We have Xavier Rollet with us, CEO of the London Stock Exchange Group. Xavier has led the London Stock Exchange Group since 2009, and before that he held senior positions with a number of leading city institutions. The Stock Exchange Group is Europe's leading exchange group. It also operates the alternative investment market, AIM, which is an international market for smaller growing companies. A wide range of businesses, including early stage, venture capital backed, and more established companies, join AIM seeking growth capital. We have Sam Gyimah MP, Member of Parliament for East Surrey. Sam has been leading the Beyond the Banks initiative, and Sam was the first MP to call for credit easing, which the Treasury was granted state aid approval yesterday. On leaving university, Sam pursued a career in the city for 5 years, before leaving to help build and develop a number of small businesses in the training, recruitment and internet sectors. Sam was voted CBI Entrepreneur of the Future in 2005. Theo Bertram is UK Policy Manager at Google. Theo was a special advisor at number 10 to Tony Blair and Gordon Brown between 2006 and 2010. After leaving government, he was head of public affairs at O2 before joining Google as UK Policy Manager. Google has been a major advocate for the Tech City initiative in East London and a strong supporter of the startup community there. And Google, later this month, Google and its partners will open Campus, which has built a Silicon Roundabout's newest co-working space and entrepreneur community. And last but not least, we have Patrick Reeve, Managing Partner at Albion Ventures LLP. Patrick became Managing Partner in 2009. He has a background in corporate finance, and in particular the financing of small and quoted companies. Albion manages 7 venture capital trusts and invests in a wide range of growing businesses, from technology to service and asset-based businesses. And Patrick is a member of the Council of the British Venture Capital and Private Equity Association. So, as I'm sure you'll agree, a stellar lineup. So in a moment, I will ask our guests to share their perspectives on this morning's topics, which are how well is government policy helping the market meet the financing needs of new, small and high-growth businesses? How can government best support business owners and investors? And if they are feeling brave, what one budget measure would make the most difference for entrepreneurs? And after they've spoken, I'll open up to questions from the floor, and we will aim to wrap up by 10 o'clock. So, with no further ado, I will ask Nadim to get us started. Nadim Zahari.
Thank you very much for that introduction. And thank you for inviting me here today. I think the theme for today for me is all about execution, i.e. delivery. You learn that when you set up a business, and I think it's very wise for politicians to learn that too. Obviously, next week is when the Chancellor will stand up in the chamber and announce to everyone what measures we are taking and what are we delivering on. And obviously we're talking about growth, but I think we do need to separate short-term stimulus measures from those that will create sustainable growth in the long term. I think today's topic, how we can finance innovation, innovation-based businesses, is vitally important. And it isn't a subject that I think there is a short-term fix for. Yes, there are some things that we can do, but the reality is we also need to deliver on the things we've already announced. I think I've made a short list of some of those things here. So EIS changes, we've already announced tax relief increasing from 20 to 30%. Company size increase from 7 to 15 million, from 50 to 150 employees, and so on. Credit easing, the enterprise zones, R&D tax credits. These are all things that we've already announced, but I think we do need to do more work to make sure they are communicated well. When I speak to businesses in my constituency, Stratford-on-Avon doesn't have a very large employer. We have lots and lots of very good, innovative, small businesses. The largest thing we've got to large employers on our borders is Aston Martin and JLR's head office in Gaydon. But the SMEs in my constituency, I don't think a single one of them, I try and do this regularly every Friday, and with my background in research, I always ask them to sort of just name me some of the initiatives that they think we are taking forward. None of them can really sort of give any of these any real detail. Obviously, some of them are still to be worked out. So, for example, with the credit easing, it is an area that is yet to be finalised, and it's important that we get the detail right. Everyone who's ever started a business, as I have, and as I think my colleague Gyimah has done, I think we're a rarity in Parliament to have sort of taken a business all the way through the different cycles from start-up. I started my business across the road with Stephen Shakespeare, two guys in a shed, and we took it public on the AIM market, the London Stock Exchange. And so one of the lessons you learn very quickly is, it's great that you've got a good idea, but you've really got to execute on it. And I guess my message to the Chancellor would be, make sure that you hold the civil servants' feet to the fire in terms of what's already been announced, what's already is in place, and start executing on some of that, because it will give business a reason to believe that you really are on their side and you really are delivering, not just announcing things because we have initiativitis in Parliament. It is as an observer, I've only been there for 2 years, it is quite unbelievable, the temptation and the pressures on you in government and I guess in opposition to always come up with another idea because of that incredible beast, which is the sort of the lobby, the media always looking for another thing that you should be or should not be doing. One of the themes I really want to talk about is equity versus debt. We really do have a significant problem. In short, we're all very familiar with debt in this country. In fact, I think we're probably too familiar, both as consumers and government, but also in business. Too much of our focus is on financing growth and knocking the banking industry for not delivering in terms of their own responsibilities towards businesses, not delivering on making sure that they deliver finance to SMEs. But actually, if you look at their model, Peter Ibbotson, who heads up SME finance at RBS, came up to Stratford to talk to some of my SMEs, and you realise very quickly that there is a perception gap. The model that we've asked our banks to deliver on is that you've got to deliver a low interest loan to businesses and make sure that those businesses are also robust so that we don't have too many defaults. The banks, RBS, cannot afford to have more than 1 in 50 defaults, otherwise they go into loss. Now we have to make a decision. Do we want them to take higher risk, but in return either subsidize them through the taxpayer or allow them to charge higher interest rates? So there is a perception gap, because when I talk to the FSB or other organizations who run surveys all the time of SMEs, and we ask SMEs what their appetite or what the bank's appetite should be for risk, they would talk about maybe a 1 in 5, 1 in 6 default ratio. And that's obviously undeliverable in the model that we've designed for our bank. So we do need to look at other forms of funding. And I do think it's important that we make the arguments as politicians, and we take a lead on this rather than being far too, I guess, eager and too quick to condemn the banking industry for not doing their part in delivering access to finance to SMEs. And so, what else is there that can be done? Well, I think there's lots. There's obviously lots of innovative businesses. Some of them are in this room, who are looking at other equity-based models, both in terms of leveraging the technology, leveraging the internet, the online model, to deliver the lender or the equity investor with the idea's owner. And I think that certainly is an interesting model for us to pursue. There are obviously private equity, and then there's the markets like AIM, which I'm sure Xavier will pick up on. But I think it's important as political leaders that we move the debate on, and we take a leadership position in terms of how we fund some of these businesses. But you are up against a challenge, and the real challenge is that we all have a natural aversion to loss. Behavioral economists could help us in uncovering some of the sort of disgust and dislike that British business appears to have to equity. So the language that we coach some of this stuff in, so we could choose to go for 100% of nothing, of owning a whole business that never gets anywhere, or giving up maybe 40% of it and getting 60% of something. And so we have to just think through, how do we sell these ideas to those innovators, to people who are starting businesses, so that the idea that they're giving up something, but actually they are then delivering and executing on what could be a much bigger idea and keeping a smaller portion of that equity. So I think it's important that we make those arguments. Now, some of the research that I've done around startups, around the people who are coming up with the ideas, I'm part of something called the Founders Forum. And I try, and again, it's anecdotal, so it's not scientific, and I wouldn't claim for it to be, but when you talk to startup businesses, what's really interesting is they're not saying to me, because I asked them this question, what would you like to see the Treasury doing? What would you like the Chancellor to be doing? They don't talk about wanting more tax incentives. They talk about actually wanting better pipe. And for them, it's binary. Their idea will either do incredibly well, and then they don't mind actually paying the taxes that are in place, or it will fail. And so what they say is, look, whether it's Silicon Roundabout or wherever else in the country, what I'd really like is decent pipes so I can get my business up and running, and I have no fear of technological failure. And so I think one of the things that we should be thinking about doing is making sure that we deliver on that pipe. It was quite disappointing. I had a very innovative television production company in my constituency. They're using the latest technologies to produce programs, and yet they have to sort of overnight a physical tape to the US so that it can be sent on via satellite from the US to Australia. They should be able to do that from the UK, not having to physically use DHL or UPS to send those sort of tapes over to America to deliver on the technology. I think sort of three things in conclusion. One, deliver on what we've already announced. Two, do something about the reluctance of business to have the use of equity to finance their growth. And three, just to remember, sometimes it's not about finance, it's about how we can just provide business with what they need, like pipe. And also, more importantly, the confidence to hire people. One of the great things about my experience in America, we acquired a business in Silicon Valley, and now, when I was at YouGov, and that now is the biggest part of the YouGov family, in fact, is the US business. But I found it quite brutal, because we were in the same building as Facebook, and some of our best programmers would give 2 weeks' notice and leave the business to join, whether it's Google or Facebook or anyone else who's paying them more money and giving them more options and everything else. And that works the other way, by the way, because when we needed to right size, because as we came to the realization that there is a problem with the financial markets, we were able to give them 2 weeks' notice. Now, on a personal level, that's incredibly tough, that's brutal to people. But actually, if you look at the way the American economy is coming out of the recession, I firmly believe part of that is the confidence of small businesses to hire people in the full knowledge that if their business plan doesn't quite deliver, or there's a problem further down the road with the economy, they can right size very rapidly. We don't have that same confidence in our country, and I'm pleased to see that the coalition has got an agreement to consult on the Beecroft report, because it's very important that we deliver a truly flexible labour market as well. Thank you very much for listening to me, and I look forward to the debate today.
Thank you very much. Xavier, would you like to give us a perspective from the London Stock Exchange?
Yes, I would. Thank you very much, and everything I just heard was just a pleasure from our standpoint at the London Stock Exchange, having advocated the virtues of equities for, well, close to 350 years now, obviously in different fashion. It was a real pleasure hearing from a leading politician. And we do value our neutrality, believe me, this is not a partisan comment. But it was a pleasure hearing the renewed appeal of equity as an asset class. And it has got to be right. 1 out of 3 startups fail within 2 years. We heard that the banks, and it makes sense, have a target of 1 out of 50. And when they lend to SMEs, their returns are capped. That's the definition of fixed income debt. Even variability doesn't provide you the returns to match the risk profile of equities. And what does equity provide? It provides an alignment between the interest of the investor and the interest of the entrepreneur. Because if the company does well, your potential return actually is unlimited. You could double, triple, quadruple your money. There's really, the sky's the limit in terms of what that company will provide. You don't ask for a lien on the assets. There are no interest payments. Exactly what entrepreneurs need, flexibility initially. On the other hand, bank debt, see capped return, significant default risk or bankruptcy risk. And at the same time, the need to make up for that risk, the need to establish a lien on the asset. So if you're an entrepreneur, of course, and you're starting particularly in the all-important innovation sectors, which rely on intellectual property, you can't pledge intellectual property. So what do? You pledge your house, you pledge whatever other assets you may have. And that is a significant impediment to enterprise. And let's say it again, bank debt is fundamentally unsuited for mathematical and technical reasons. It is unsuited, not the right funding vehicle for innovation. And of course, equity is the right instrument. And I think here we have to frankly be honest with ourselves. And this is not a comment specifically to this country. It is generally in the Western Hemisphere, particularly in the Eurozone, which has accumulated over the last several decades a massive amount of debt, affecting not only in the last 4 or 5 years the financial services industry, but also, and more importantly, the government sector. And we are truly in an environment today where the crowding out effect of that massive overhang of debt is inhibiting policy decisions that would help redress the current imbalance in 2 areas: regulation and fiscal policy. Current imbalance in favor of debt and against equities. And it's not just the fact that equities are taxed very heavily, whether you look at the corporate cycle, whether you look at capital gains, whether you look at dividends, and now with the European proposal to set up a financial transaction tax. Interestingly enough, the only area where FTT will not apply, according to its proponents in Europe, is government debt. Policymakers do understand that transaction tax increase the cost of capital. They're not prepared to apply it to their own debt. And that's the issue. There's so much government debt that policymakers are reluctant to do anything that would redress the imbalance and potentially inhibit the liquidity in that market, because there's a lot of the stuff to refinance. Let me give you another example. And this one pertains to the cost of raising equity right here in the UK. The stamp duty, that old favorite bugbear of the stock exchange. Turnover velocity in the UK market is the lowest in the OECD, at 50%. UK equities effectively take 2 years to turn over. Well, some people might say, is that a bad thing? Well, it's a bad thing if you're an entrepreneur. It's a bad thing particularly if you're in the all-important technology sector, where turnover velocity is very important. And why is it a bad thing? Well, look, for example, at a US equity market, the technology market, the NASDAQ market. Turnover velocity in the NASDAQ market is 500%, 10 times. And what that converts into, because of course the frictional costs pertaining to trading technology equities in the United States are a lot lower than the UK. What that converts into is a cost of capital which is 15% lower in the United States than in the UK. Now 15% may not sound like much, but with the compounding over a 5-year period, it effectively means the cost of capital is twice as high here as it is in the US if you're a technology company subject to the volatility of technology innovation. And that's where, and the same picture applies to Europe, although to a lesser extent, because at the moment they do not have the same fiscal pressure on equities. And we can talk about regulation. The cost, particularly for AIM companies or plus market companies, those very small companies, that in order to raise equities, and they don't need that much, 5, 10, 20, 30, 50 million, we're talking about small chunks of capital. The cost of maintaining a listing, and we're not talking here about the listing fees of the London Stock Exchange, which I assure you are extremely competitive. At the junior end, it's £5,000 a year to list a small company. So most entrepreneurs can afford it and they don't have to mortgage their house. But what happens if you need to satisfy all the regulatory requirements, publicity, accounting, which of course are important for investors. But when you look at the cost of providing that disclosure, well, in the UK it's about £150,000 a year. In the Eurozone it's worse. On average, 250,000 euros a year just to satisfy the growing array of regulatory requirement disclosure, which have not been streamlined. Now, if you're going to raise 5 or 10 million for a startup, and you've got to spend $250,000 a year just to maintain that listing, it's obviously not worth it. So we also have an issue with the cost of maintaining regulatory standards, which have grown effectively way too much. What we are arguing is and what we're proposing is that, of course, there has to be a debt component in terms of the financing of innovation. But it's important that policymakers consider the chain effect. This is not a one-off financing. Company grows. There are particular financial instruments that are very suitable at the startup level. As the company evolves and succeeds, other kinds financing resources become necessary. And yet, yes, debt has a role to play. And we welcomed the initiative last year in the context of credit easing to use some of the resources of the public purse, of the treasury, and apply some of it to the SME sector. But it's important to maintain a liquid chain throughout the life of the company until it becomes large enough not to have to worry about raising equity anymore and migrates into the senior levels, FTSE 100 or whatever. If at any point of that chain there's a substantial gap, you end up with a company forced to either sell out, move, or sometimes just disappear. And if you look at the AIM market, at the peak, in excess of 3,000 listings, post the credit crunch, this number of listings shrunk to about 1,400. And it's a fairly unique market. There's only 2 others like it in the world. One is in Korea, the other one in Canada. Nothing like that exists anywhere, for example, else in Europe. But more than 2/3 of the shrinkage from the top to where we are now was due to M&A. And that tells you a story. Obviously, there are SMEs merging amongst themselves. But often in the financing chain, when you lack the financing to go to the next stage, not because you don't see the growth opportunities, not because your employees can't support it, or not because you're lacking ambition, just because you can't secure the finance, what do? You basically, knock at the door of a very big company who's attracted to your innovation and sell out. And that may be okay in terms of a short-term monetization policy or securing an exit. But in the long run, the Googles and the Microsofts and the Facebooks of the world tend to emerge a lot more in the US, where their financing chain is secure throughout the life of the company, than over here in the UK, and the situation is even worse in Europe. And it's no surprise when you look at statistics, particularly AIM companies. 55% of UK SMEs beyond AIM use credit cards as a financing tool. Only 3% of them use equity as a financing tool. I want to say a quick concluding word on debt as well. We do see promise in terms of credit easing type policies to help secure financing for SMEs at a later stage in their life, post the startup phase. And we know it can work because we do operate in all countries in partnership with the Italian Stock Exchange. Last month in February, the Italian government launched a similar initiative using quantitative easing to provide guarantees, not direct funding, to SMEs and mid-sized Italian companies who were otherwise barred or unable to secure debt financing from the banking sector. In 2.5 weeks, we raised over 30 billion euros for 326 companies, listing their debt on our local market. It's a funny name, it's called MOT. We won't use that name here, but essentially, it's a retail bond market. And it's a substantial source of potential finance, which we're trying to develop here in the UK with the launch a little over a year ago of a retail bond market for corporate issuers. There is substantial appetite in the asset management industry and in the retail investment sector for higher yielding corporate debt, including SME debt. For the simple reason, of course, that yields on bank deposits these days are not overly generous. And so if you can match that available pool of capital with a guarantee, it can be either full or partial, backed by a quantitative easing program like the Italians do. You take out the need for credit ratings or other forms of financial analysis and enable the corporate sector to raise significant capital from the retail sector. And we've been very encouraged by the recent success of that issuance in Italy, and we believe other countries, Germany, for example, is also looking at that particular scheme. So we obviously are welcoming all the initiatives that policymakers may take in the space, and we'll be, as you can imagine, pouring through the details of the budget. But the one encouraging theme which certainly we've picked up in the last 9 to 12 months, is that the power of equity as a fundamentally well-suited financial tool for purpose of SME growth and innovation, keeping in mind the 4.8 million SMEs that operate today in the UK. And the acknowledgement that this is actually the solution to the job creation deficit that Europe finds itself facing. The acknowledgement that this has got to be part of the solution, we believe is a major step forward. Thank you very much.
Xavier, thank you very much. Gyimah, MP.
Well, thank you very much, and thank you for having me here today. I think this is a fantastic event, and it's a fantastic event mainly because for anyone who's followed the pre-budget debate so far, you'll have noticed that a lot of the discussion, certainly in the media, is on the fiscal side. Who are you going to tax to be able to spend on whom? And that's because there's a big emphasis on austerity, and so politically, we're all focused on how we're going to share the burden of austerity. But by the Chancellor's own admissions, we're only going to pay 30% of the deficit from austerity measures. 2/3 of paying the deficit has to come from growth. And if we're talking about growth, then financing innovating businesses in the UK is absolutely critical to that. So that's why I think this is a fantastic event to have, because it's actually one of those events that is much needed, but is actually not being had, or the debate we're having here is not being had in the media more broadly. The second reason why I think this is a fantastic event is we live in an environment now where, certainly I feel the Labour side in Parliament has decided you cannot be anti-business enough. You cannot be left-wing enough when it comes to bashing business. But if we're going to pay down the deficit, 2/3 of the deficit from economic growth, and if we're going to improve our living standards, raise employment, and also ensure our long-term prosperity, then we cannot do anything other than have a budget for business, in my view. So for those two reasons, I think this is absolutely relevant as a debate. A couple of points that Nadim and Xavier made that I'll reflect on first. I think Nadim is absolutely right when he talks about execution or implementation or whatever you call it. Certainly from my experience working as an entrepreneur, I had my ups and downs, but one thing you know is people in business don't spend their time trying to find out what's the latest government initiative that is going to support them. People who are starting their businesses spend a lot of their time trying to make sure that they get sales, trying to make sure that they can pay their bills, trying to make sure that they can hire their staff. And for that reason, there is a significant lag time between the government announcement of an initiative and actually businesses either understanding or knowing how to make the most of that initiative for themselves. And say take the Business Growth Fund, which is a 2.5 billion equity fund, part funded actually by the banks. Now, this was announced 18 months ago. It took about a year to set up, and it's doing its first deals now. I think it's going to be incredibly successful. It's a modern day 3i, which was set up after the war, but you need to give it time to actually gain traction. And I think that is why Nadim is absolutely right to say there are a lot of good initiatives out there, but rather than actually increasing the number of initiatives, or if you're going to increase the number of initiatives, that should not come at the expense of making sure that what has already been announced and is out there works very well and works for business. The second point I'll pick up on that has been made is Xavier's point about equity and debt, and debt not being suitable for all types of businesses. Of course, you need, as a business, you need different types of capital at different stages of your development. If you have an idea that is completely unproven, even if it's going to turn out to be the next Facebook, and you don't have any projected revenues, and all you've got are engineers coding away, it's very difficult to get a bank to say, we're going to lend you money against an idea where you've got no revenues for the business. So in that situation, it makes sense to get risk capital, i.e. capital from investors who understand that if things don't work out, they could lose everything, but if things work out, they will make 10, 20, 30 times their investment. And that is why schemes like the Enterprise Investment Scheme, which is to encourage high net worth individuals to invest in early stage companies, are a very good idea, and it's been great to see that the government has actually relaxed a lot of the rules around that. Now, moving on, from there, how do we finance innovative businesses? And I like the idea that the emphasis has been put on innovative businesses, because in this sort of anti-business environment, whenever you talk about a budget for business or backing business, what people normally think is, well, conservative, you're going to be talking about tilting the landscape in favor of the vested interest of multinationals. But I think the businesses that I'm concerned about the most here are, the Body Shops, the Dysons of this world, the white companies of this world. These are British success stories set up by entrepreneurs over long periods of time. Dare I say YouGov, actually, set up by entrepreneurs over long periods of time, where they put some of their capital in and they build the business over time, employ people, and actually become national success stories. I have a view that, the big companies can look after themselves, but if there's any, this is the sort of sector where they don't spend their time employing lobby groups, they don't spend their time hanging around Westminster trying to see what they can get out of the system. Those are the people that I think we as politicians should really look to help to support. And in terms of supporting them, I think there's one big way to look at it, and which I've been doing in the Beyond the Banks project, which I've worked on over the last year with Nesta. And I started working on it because I realized the political debate was all around how you can bash the banks to lend more. So if you can bash the state-owned banks to lend more, miraculously we would have lots of startups springing up, employing lots of people, and actually spurring our growth, which is simply wrong. You really need to get into the mechanics of how to fund these businesses. And what I identified, speaking to a lot of entrepreneurs, speaking to business people and economists, is there are pools of capital available out there. It is governments that have run out of money, but there are a lot of other people who have money out there. And so for me, the question is, how do we channel this money that is out there in a way that funds the businesses that need it? Or to put it another way, how do we get all this money that is out there into the real economy? And there are a number of ways in which I can do that to benefit innovative businesses in the UK. But it involves completely changing the funding landscape that we currently have. Certainly, 90% of bank lending in the UK is done by 5 banks. And lots of free marketeers tell me, well, if you're creditworthy, surely your bank will lend you money. But it's not as simple as that. Even if you're creditworthy and often you want to get a loan from your bank, firstly, it could take you 3 to 4 months to actually get an agreement if you're lucky. Secondly, if you get a loan from a bank other than your bank, often you have to move your account to that bank. Now, if you think of yourself as a consumer, and you look at the consumer end of the market, you can have a credit card from one company, a mortgage from one company, a bank account from another company, and then an overdraft with that bank. You have multiple financial relationships with multiple financial institutions. But if you're a business, you'll often find yourself locked in to 1 or 2 institutions because the market is heavily concentrated and also not very transparent when it comes to pricing, and the negotiating power is all in favor of the banks and the large institutions rather than the business. So for me, the question is, how can you get the capital that is out there into these businesses, and how do you do that? By altering the lending landscape to do so. The preferred method of a lot of people is some kind of state investment bank. But my view is these kind of things take quite a long time to set up. But also, as Nadim said, if you have a state investment bank, given that there is a failure rate with a number of businesses, is it going to take more of a hit than the commercial banks that are out there by giving cheaper loans? Or we've also put 45 billion into RBS. We've got to get that back before we set up another investment bank. That's what I personally think. So I think we need to look at more sort of private sector-led initiatives. But that's where credit easing comes in. I think in the short term, credit easing, which I called for last year, makes sense. And I think credit easing makes sense because what it's doing, it's supposed to guarantee bonds that banks issue so banks can raise money And that money, when banks raise that money has to go towards SME lending. Now, how does it benefit a business? It should potentially benefit a business because if a bank is able to pass on the low interest rates it gets because the government is standing behind them when they try to raise money in the markets, and if that interest rate is passed on to businesses, that reduction in interest rate is passed on to businesses, it could make a huge difference. So, for example, if I'm a business trying to borrow £10 million to grow, and I get a 1% reduction in my interest rate as a result of the fact that my bank has benefited from the credit easing scheme, that's effectively £100,000 that I've got back. Now that £100,000 at the median salary in the UK could employ probably up to 4 full-time equivalents for a year. So that's an example of how something like credit easing can actually benefit real businesses. But I see the government getting involved in this as a temporary measure. In the long term, I think what we need to do is we need to get private sector-led initiatives to work. And the great thing is there are a lot of these innovative and enterprising initiatives to fund growth businesses out there. You know, there are a number of organizations, there's Funding Circle, where high net worth individuals go onto an internet platform and can do some due diligence and find businesses that they think are worth investing in and investing directly. There's Market Invoice, there's Crowdcube, where businesses that have invoices, so you've actually done the business, you've got an invoice, but you know that it will take 60 days to get your money back. You need to pay your staff today. You can borrow against that invoice that you know is going to get paid. Now, ordinarily, in the case of invoice discounting, if you try to set that up with a bank, it could take you about 4 months to negotiate. They will certainly want a charge on your house. They will certainly want a lot of government guarantees, and they will charge a lot of they will charge significant arrangement fees and monitoring fees for that. But with a lot of these new disruptive technologies that are out there, you're doing it on the internet, so it's significantly cheaper. It's easier to organize, but also you don't have all the, the legal, unnecessary legal constraints that can come with this, and it's very quick. So that's an example of how there is a lot of innovation, disruptive innovation out there that helps businesses that I think government should support. Now, how can government support this new wave of innovation? And I'd say it's banking regulation. In our attempts and in our desire to ensure that we make sure that we regulate our banks so that the failures that we've seen do not happen again, we've got to be very careful that we don't freeze the system in some kind of aspects. So it doesn't take account of the fact that there are going to be a lot of new models out there that could service the customer in very different ways. And I think that's something that's why we've got to be very careful about how we go about regulating our financial institutions, and especially these new ones that are out there. The Obama administration has noticed that. It introduced a bill around crowdfunders, actually bringing it to where we are in the UK, but it just shows you how we've got to be very careful in this space. Now, the second thing to do, other than sort of supporting disruptive, innovative providers of finance, is there are other non-bank lending institutions. And this is where I think the Business Finance Partnership, which was announced in the autumn statement, I think is very interesting. Because why does it have to be a bank that provides finance to debt finance to a business? You've got the London Stock Exchange that you could use as a platform to raise debt finance, but there are also a lot of other non-bank lending institutions out there. MMG, the big institution, launched a fund for businesses. And I think what is interesting, we should be supporting these sort of non-traditional, as far as the UK is concerned, lending institutions that can get credit quickly to businesses. Because getting credit out there is purely a function of being able to understand risk, analyze it, and make the appropriate lending decision. So what we need to do, I think, in the UK, where we lag a lot of our competitors internationally, whether it's the US, Germany, or Italy, is we don't have the alternative providers of finance, whether it's some of we've got these new ones that are coming up, but also some of the more traditional forms. So our bond markets lag significantly behind the US, we lag significantly behind Italy, and the same with Germany. And also we don't have enough regional institutions that can service regional businesses. A lot of these institutions were there before the financial crisis of 2008, and a number of them have pulled out of the market. We need to create the right environment for these institutions to operate in them. So firstly, innovative businesses. Secondly, non-bank lending institutions. And the third thing that we need to support is, I think there are a lot of private individuals out there who are interested in backing businesses, whether it's a business in their hometown, whether it's a business in their community, or whether it's a business, that just because they've got money and they want a better return than they get from a bank. So if you, for example, invest in a bank at the moment, you get 2% interest, but maybe if you lend your money to a business, you can get 8% interest. And what we need to do is encourage and allow that retail capital to get into businesses. And the way to do that is really to look at how we tax people when they invest in equity, or versus when they lend lend to a business. That is something that we need to look at very carefully. There are other ways. So those are three ways in which we can get finance to innovative and enterprising businesses. The final point to make is that UK companies are sitting on record high amounts of cash on their balance sheet. I think it's something like 730 billion, that's a 40-year high, and it's the same in the US. In the US it's 1.3 trillion dollars, I think. It's probably 1.17. But anyway, these are record high amounts of cash on companies' balance sheets. Now, this is because companies have been very smart. Companies have been very clever over the last few years. They've hoarded their cash. And I think I saw a story in the BBC that Apple has more cash on its balance sheet than Poland or something like that. But this is it. It's the governments that have run out of money. Corporates have money, sovereign wealth funds have money, a lot of private individuals have money. Now, in terms of corporates, what we should be looking to do is trying to encourage corporates to lend to more companies in their supply chain. If you are a building company, you know a lot of the constructors that you deal with. You know their business, you know the market, you understand them, you've been dealing with these people a long time, you've eyeballed them, you've seen their invoices. And I think creating a system where these companies become more incentivized to lend to organizations and businesses within their supply chain will be another way of getting cash out into the real economy and to support these sort of enterprising and innovative businesses. So to round up, governments have run out of cash, but there is cash out there. What we need to do is change the lending landscape, or say the funding landscape, so that we can get that cash from where it's sitting into the real economy. And in so doing, also what we need to do is not just be tactical or short-termist in a way that I think credit easing can provide a real shot to the economy, but look to create a completely new landscape so that at every stage of a business's growth cycle in the UK, they have the funding they need to be able to grow and actually conquer the world. In the UK, if you're a business, if you're a technology business, you want to sell to Google, you want to sell to Amazon, you want to sell to Twitter. Why don't we have businesses that want to become the next Googles, the next Amazons, the next Twitter? We've got to make sure that funding doesn't stand in the way of our entrepreneurs achieving those ambitions. Thank you.
Thank you very much. Theo Bertram from Google.
Thanks, Chris. Very happy to be here today on behalf of Google. We're going to be starting some work with the BBCA and the London Stock Exchange, led by Policy Exchange, and we're very much looking forward to seeing what we can learn through this process. I really wanted to make just 2 points today. One is a kind of specific what we'd quite like to see in the budget from the perspective of a large US tech company that thinks a lot about how to attract investment to startups from VCs and angel investors. And then the other point I want to make is really a kind of perspective on the broader connection between the state of a country's internet and the state of a country's financing and the state of the country's innovation. So on the first point, kind of the one specific thing that we would say you should have in the budget, I would start by put yourself in the shoes of an investor who's looking at a company, and you're going to make it's going to be a risk, it's going to be a gamble. And you look at the company and you're thinking, is the gamble going to be, does it fly? So is it going to be commercially successful? Is the innovation going to work? is this a service or product that's going to take off? So does it fly? Or is the risk that you're taking, is it legal? And the nature of the tech business is that everything online is about copying stuff. That's the way the internet works. And so a country's copyright laws matters incredibly importantly to a tech investor. Because am I going to invest in a country where I'm going to get, where my money is going to go into the innovation, or am I going to invest in a country where the money is going to go into lawyers' fees as we negotiate copyright law? And there was a Harvard business professor called Josh Lerner who's done a study which shows that immediately following a clarification in a US court on a cloud computing decision, that an additional $1.3 billion flowed from investors in the US into cloud computing tech businesses. And Booz and Co. Did a recent study where they surveyed, I think it was 189 different angel investors, the most prominent ones in the States, and they said, what is the key thing for you? And they said, it's copyright law. And they said that more than 80% of them would be deterred from investing in a country with a really strong economy if it had uncertain copyright law or bad copyright law, as opposed to a country which had poor economic status, but which had strong and clear and flexible copyright law, they would prefer to invest in. So, in terms of kind of what is the one message that we would give to George Osborne to put in his budget, it would be update and modernise copyright law. And I think the government are already doing that with the Hargreaves review, and the Hargreaves proposals will update and modernise copyright law. And we would encourage the government to hold their nerve there and to continue in that direction. The second broader point I want to make is based really on an interesting piece of work by Dr. David Cleaveley, who's an academic at Cambridge University. And this is really, you can kind of get caught in a discussion about correlation and causation, but what he showed was that he mapped a country's ability to weather the economic storm against the strength of its internet, and showed that these two things mapped perfectly onto each other. And the way in which he measured the ability to weather the economic storm was government 10-year bonds and what was the level of those. And the way he measured the internet economy was using an E-intensity measure, which has been developed by the Boston Consulting Group. So it looks at how much e-commerce takes place, what's the level of infrastructure investment in the country, and so forth. And these two things map perfectly. That you have Portugal, Ireland, Italy, Greece, Spain, all have low levels of E-intensity. Their internet structure is not as strong as Germany, the UK, and Denmark. And France and Belgium somewhere in between. And the two things map perfectly. Now you could say, you could look at this and say, well, of course they do. That countries which have stronger economies are of course able to invest in modern infrastructure, and that's clearly just a correlation. But he goes on to make more of an argument around the causation, that actually investing in an internet infrastructure makes your economy more able to withstand economic shocks. It's easier to reach an international market. It's easier for businesses to open and close. And we would say from Google's perspective that investing in the pipes, as Nadim puts it, and I think you're right in describing that scenario of small businesses worrying about the technical infrastructure. But if you invest in the pipes, you don't just create a country where businesses can grow up and thrive and reach an international market without having to have stores all around the world, but simply sitting on a desktop. But you also create a country where you're starting to change the notion of risk, the notion of being an entrepreneur. It's suddenly a lot easier to be an entrepreneur if all you need to do is open an eBay account and start selling whatever it is you want to sell. And that notion of strong internet economies, I think, does not only make your economy more flexible and responsive to shocks, but also means that you start to change some of the deeper underlying cultural issues around risk and being an entrepreneur. And if we want to, so this would come back to my second point, which is if we want to attract investment, then you need part of it has to be a cultural change in our landscape. which is we need to be a country that is prepared to take risks, that is willing to attract financial investment from the rest of the world. So, in summary, then, kind of the one thing that I would like to see in the budget would be greater clarification on copyright law, and if I could have a second thing, it would be invest in the pipes. Thanks.
Yeah, thank you very much. And finally, Patrick Green.
Thanks very much. One of the unfortunate things about being last in the queue is that all my amazingly insightful and original points have already been made, so I'll be slightly shorter. So starting off there with a memory from my father, he told me about when he had lunch with a few colleagues from the city with Margaret Thatcher in 1975, when she'd just been made leader of the Conservative Party. Other than commenting that she was a remarkably handsome woman, he said that during the discussion there's a lot of debate about and whinging really about the secondary banking crisis which had just finished. And she was quite quiet for a while, and then she slapped the table and said, "You're all far too gloomy." And that's slightly how I feel now. I think we are all a little bit on the gloomy side, and I think that there is a huge amount of positive things going on in the UK. I think apart from the fact that we are politically and socially stable, we are quite a dramatic magnet, I think, for overseas talent. We have 4 out of the world's top 15 universities, and I do believe that we have a very strong supply of innovative global businesses. I think that the status of the entrepreneur has changed dramatically over the last 30 years, and that we now do genuinely have an entrepreneurial culture. If I do have a sort of concern, I suppose it's around the current loose talk about tycoon and wealth tax. And I think my sort of bigger picture is that I'd have real concerns over the longer term, were we to get back to a position whereby it was somehow shameful to actually get rich. So that's my sort of overview. In terms of growth, clearly we do have a growth problem. I think both this government and the previous government have done a lot of very helpful things on a sort of relatively micro scale. I'm a huge fan, for instance, of R&D tax credits. I think patent boxes is really interesting. I like this new SEIS scheme for angel investment, particularly if it can apply to academics. A lot of good work has been done with EIS and VCTs, but clearly we do have a growth issue, and I don't really believe at this stage that we've come up with any killer apps. As regards bank lending, I agree with what's been said so far. I don't think historically banks have been particularly good at lending to SMEs. I think they feel relatively uncomfortable in that area. They don't make money out of it, it's very fiddly, they tend to underprice in the good times and overprice in the bad times. And I think they're much better suited to their traditional role of providing trade finance and working capital, rather than longer term debt to growth businesses. I think that sort of activity needs to come from non-bank finance, and an example of that is clearly private equity and venture capital. Just looking at that sector, there is currently amongst the BVCA members about 72 billion of dry powder, unspent committed funds. That's a huge amount of money. A relatively small proportion of that is in the venture space, but venture is and has been a major engine of growth in the past. In a recent survey of venture-backed companies in the UK between 2006 and 2010, saw a massive 80% growth in employment in those companies, and that is hugely significant. But institutions really aren't putting that much money into venture at the moment. They've got other sources, they've got other calls on their finance, other issues to go deal with. So if I had a wish for the budget, it would be to build on the considerable success over the last 15 years of both EIS and VCT in terms of attracting retail investors, and is there a way by which we can also attract longer-term institutional investors to co-invest with them and to share in their risk mitigation techniques. So that's my core wish. My core overview is that as long as we've got an entrepreneurial economy, I'm not too gloomy. Thank you very much indeed.
Okay, nice to end on an optimistic note. So a lot of food for thought there. I think what we'll do now is open the floor to questions. So if you could wait for the microphone to reach you and perhaps tell us your name and organisation and who your question is for. Who would like to go first?
Hi, I'm Christine Quigley from Edinburgh Public Affairs. I was very interested in what Mr. Gyimah was saying about leveraging private individuals' wealth to fund SMEs and startups. And I was wondering, does the panel think that there's any mileage in using kind of cooperative or credit union type structures that are already in place to act as a mechanism for doing that?
Sam, would you like to respond?
Well, I'm not really sort of an expert on credit unions, but the general argument I would make is what we need is a diversified lending landscape for businesses. As a business should not be hooked to a bank or any one financial institution. Businesses have very different needs at different stages of their growth, and even different cycles at different times of the year. So anything we can do to make sure that that landscape is as diversified as possible is useful. But also in diversification, you bring down the cost of lending. You introduce competition into the market. So for those reasons, you want to be supporting a diversified market, not just more banks, but other sources of capital for businesses.
Okay. What other questions do people have? At the back.
Hello, my name's Rupert Halley from Digital. I would disagree a bit with the point about companies being worried about pipe. I mean, if you're in London, you can get pretty good broadband, without worrying about it. I'd say that one of the things that we're sort of more concerned about is finding good staff, and this is a problem that every startup finds. There's a lack of educated people coming into the market. There's no coders coming through. There's a huge problem that's coming down the tracks, and if that's not sort of dealt with now, you've got a big problem coming down the road.
I totally agree on the point about skills. And when Eric Schmidt was over here in the summer, he kind of raised his concerns about coding teaching in schools. When I was growing up, we had BBC Micros, and you got taught actual coding in schools. I mean, it was on TV when you came home from school as well. My basic coding consists of kind of line 10, print name, line 20, you go to line 10, and then my name would fill the screen. But that was coding. And I think that where we've drifted into, and in a well-meaning way, where we've drifted into is the sense in which we need to prepare people for work, and what they need in jobs is to be able to use basic word processing packages, various other packages. We've kind of kidded ourselves in thinking that's what we need to train our young people to do. And clearly, if we want to have, if we want to meet this huge demand that's going to rise, not just in coders, but we know that there's going to be a huge data revolution in the next 5 to 10 years. McKinsey did a study showing that we need not just coders, but people who are able to understand data and able to think in kind of in numbers, algorithmic ways. Then we need to have that back on the curriculum, back taught in schools. I think the government are responding to this, and I think they recognise it's a problem, and they are addressing it. But I think we've got a long way to go.
Okay. The gentleman in front.
I thought Raspberry Pi was the complete answer to all the coding deficiency problems in the workforce. I'm Rod Dowler from the Industry Forum. I started life as a programmer, now I do some angel investing. I think the problem with SMEs is actually slightly more boring. I mean, companies like this, people always want to dwell on risk capital, venture capital and startups, Google or Apple, etc. But someone mentioned there are 4 million SMEs in this country, and they employ nearly 50% of the workforce. Actually, the kind of funding they get for working capital does come from the big banks, they really haven't got time to go for credit factory or bond, raising bonds. And traditionally, banks used to provide this through relationship banking. But now, when you went into a recession, the bank manager was able to provide on his own say-so a little bit more money for working capital because customers were paying more slowly, and that has declined very substantially over the years. So my view is that we need to get back to relationship banking, whether it's internet-based or personal, or through the branch manager. And I don't see how that is going to happen. I don't see many initiatives to create that.
Okay. We don't have any bankers on the panel, but would someone like to offer a few comments?
I mean, what the banks will tell you is that out of the 4.2 million SMEs, only 9% actually apply for any kind of loans. The rest are quite happy not doing so. And out of those, I can't remember what the numbers are, but something like 85% are successful in their full application, and another 15% in some partial lending. My sort of reaction to that is to go back and follow what is happening to the rest of the market. So if there's only 9% applying, what is the disincentive for those others that aren't applying? They can't all be comfortable not wanting to take on growth capital for whatever reason. And maybe part of that is actually they don't even bother apply because of what they're reading, what they're hearing, is the treatment that, and also, more importantly, they are most influenced by people like themselves, so by talking to other SMEs and their experience of banks. But I think you raise an important point. I think part of the answer isn't to sort of compel banks to sort of try and go back to relationship bank, because they're not going to do it, is the reality. The answer is to create more competition, which I think goes back to what Sam was saying, i.e. you create one, hopefully more banks that can come, not necessarily government banks, because I don't think that's the answer, but actually create more banks. We've got now a bank wanting to set up which is going to specialise in SMEs. That is a private initiative, nothing to do with government. And other forms of access to finance that I think the panel have touched on in their presentations.
I don't think the relationship needs to come just through the bank. It could be new entrants. It could be Google, for example.
Well, you're absolutely right. I mean, Handelsbanken, which is the Swedish bank, is very much based on a relationship model. Handelsbanken, very much based on a relationship model. They've never lost money. They've got a banking license in the UK and are expanding because they realise that is a gap in the market. The point I'll add to that, though, having been in the startup world as before, is often business owners don't really have an idea of what else is out there other than the bank. There's a massive information gap. So your first stop is you go to your accountant looks at your management accounts and then says, oh, go to your bank manager. But actually there is a lot out there, and the question is finding out, and probably a business idea for someone here is we need a money supermarket for businesses, where if you want to get some sort of business finance, you can go and be able to compare the different products that are out there. A constituent of mine wrote to me, I put him in touch with one of the crowdfunders who had been at an event and gave me a business card, and they raised £100,000 in 2 weeks. So there are opportunities, but I think that you can't underestimate that information gap between business owners and what is out there, because they've got their heads down just focusing on their business.
Okay, thank you. Gentleman in the red tie.
When I hear the five of you speak, I bang my head against the wall. The short-termist approach that you'll have about growth and about setting up and about the get-rich-quick type approach that this country has is just in our DNA, and there's no incentive for a family-owned business to go from a turnover of a medium size into a big business. They might as well sell it off and make some money out of it, and then move abroad so that they don't pay tax. What real incentive is there for someone like me who wants to start a business to actually really do it rather than go somewhere that which wants us?
Who'd like to tackle that?
I think I opened by saying that actually there's a difference between a long-term growth strategy and a short-term stimulus. And I think we need to sort of differentiate between those two things. And I think slightly unfair to the panel to say that nobody talked about how you would actually keep businesses there. I think I heard lots of people on the panel talking about how do you stop businesses? I think Xavier mentioned it, actually selling out too early, and you see that evidence. I'm working on a project at the moment where if you look at sort of first and second round funding in the UK, we actually do quite well compared to Silicon Valley. We get about 300 startups a year. They get about 350. We fall off the edge of a cliff when it comes to third round. So if the 5 to 10 million funding, we go down to 60, they go up to about 400 plus in Silicon Valley. And actually, how do you bridge that gap? It's something that I'm looking at the moment. But I'm sure my colleagues on the panel would like to defend themselves.
I think there was a very interesting point presented earlier. I think it was you, Sam. There is a surplus of capital available at the moment in Europe, in the UK, and also in the United States. And that surplus of capital sits with the companies. And yes, they could lend to their suppliers, but they could also invest by equity instruments. And I think the message Sam gave is a very powerful one. If you're a Google or a Microsoft, or if you're a Glaxo, if you're a large biotech or a technology company, you are going to have a very good view in your own sector. When you see something new coming up, you could get it wrong, but your views are likely will be better informed than most others. And so large companies often, not always, tend to suffer from an innovation gap because they get so large and so successful, they generate so much cash, they spend time with investors, they start thinking or worrying about cost cutting. They tend to be by nature less innovative, but they certainly can tell a good thing when they see one. And so one of the very substantial sources of capital would be large companies being properly incentivized through some sort of investment tax credit, i.e. being able to invest through private equity placements, investments, in the same terms as they invest in their own plant and equipment and get tax relief. And there are successful examples right here in the UK. I'd like to mention the case, for example, of Ceres Power, alternative energy, which would not have effectively been able to get started without an investment, a seed investment from British Gas. And I think if governments at the EU level, because there are state aid issues and EU legislation, but if we could get a European-wide investment tax credit enabling large companies to get relief or external investment in their sectors, in innovative company, equity investment, we could free up hundreds of billions of pounds, euros, or dollars of capital and really turbocharge the equity financing chain.
I don't know if the gentleman was referring to sort of personal taxation, or were you referring to companies?
It's everything. It's personal tax. It's aspiration. It's the bank. It's anti-business aspects in the media. If you start a business, you've got the punishment of regulation. If you're successful, you get the punishment of the media saying you're too successful, earning too much money. There's no incentive to start a business and do well.
Okay, I thought that's what you mean. I think that's definitely one thing that we need to encourage, but that's a cultural thing. Is the culture of, and I think you touched on it, risk-taking and adventure, and the optimism that goes with that. And in the US, not only do you have that, but you also have people starting it very early. And I saw this story of the guy who set up Mashable, an online blog, who dropped out of university and is now about to sell his business to CNN for £127 million. And I just asked my office, is there a link between people dropping out of university and setting up, really successful businesses? And I don't think there is a link per se, but that sense of I'm going to do something on my own, I'm going to strike out on my own, I'm going to do something different, and if I'm successful, great. If I'm not, it's part of life, it's part of the adventure. I think we need more of that culture here, and I think it's a bigger discussion in terms of how government can help encourage the creation of that culture.
Jacob Kakak from Jaguar Land Rover. Just a couple comments, and then my question was actually going to be on this culture of risk-taking. We're a large OEM, big issues in our supply chain in terms of growth. We have over £1 billion of profits, hopefully with an increase. We have absolutely no capacity to lend or invest in our supply chain. Every bit of money we make goes back into product development, and that's the reason why we're so successful. So we do take some corporate venturing punts on some technologies, but it's not large scale. And so I think we need to think about the types of companies that might have supply chain growth issues. In terms of corporate venturing, there is a corporate venture tax relief in the UK that sits alongside the EIS and the VCT. With the pre-review coming out tomorrow, it'd be good to know why that hasn't been successful in terms of providing corporate tax cuts for corporate venture. In terms of risk-taking in the culture, that's the value of competition in the banking sector. It's not so much can banks take on more risk in terms of lending, is how do they take a different view of risk? And I think that's where the real benefit from competition comes. In a similar event a couple of years ago, there's a show of hands of what was the view of failure in the room, and 75% in the audience said failure was a bad thing. Go to the US and it's a badge of honor. I was wondering, my question was going to be on that kind of wider debate, how do you encourage that shift in view in terms of risk and culture?
I think you raise a very important point, and I tell you for why. I think if you look at the whole debate around rewards for failure, and we touch on this in Masters of Nothing, I think what people dislike is the disconnect between performance and reward. When they look at executive pay, for example, the thing they sort of really are unhappy about, which is why you see so much of it in the media, is this idea that if you do well, you get paid millions. If you do badly, you still get paid millions and the severance package. Nobody, as yet, I certainly haven't read anyone criticising Mark Zuckerberg for making sort of more money than God. Because people get it. They get that this is a wealth creator. He's actually built a business from nothing. And so I disagree. I don't think we have a culture that is anti-wealth or anti-risk-taking, anti-business. I think there is a sort of a reaction to rewards for failure. And I think it's important that as politicians, we do take a leadership position on this and actually differentiate. I thought it was very sad to see politicians across the road jumping on a bandwagon and attacking Stephen Hester for actually doing a good job. Not a single person said to me that Stephen Hester is doing a bad job, yet lots of politicians very quickly rushed out and condemned him for getting what was in his contract. Now, the sort of the flip side of that is, his predecessor walking away with millions in a pension pot and severance packages, and others who did fail very badly, and not just in banking, in lots of other sectors. I think it is upon us to sort of make the argument, certainly from sort of the right of centre parties, in favour of capitalism, in favour of the culture of capitalism, because it's a great force for good. No one in Asia is having a go at capitalism because it's lifted so many millions of people out of poverty. And I think part of the earlier question at the back sort of alluded to this. Part of our duty as politicians is to sort of go out and lead on these arguments, to actually differentiate.
Patrick on enterprise culture.
I think this is working actually. I think you make a very interesting point about rewarding failure and about the risks of failure. When I started out in venture capital over 20 years ago, there was an absolute rule: you never backed anyone whose business had gone down. For sort of obvious reasons. These days, that's quite different. It's much more nuanced, and we have backed a number of people whose businesses have failed, and actually have done very well. And I think that it's just a lot more sophisticated now, and I think it's part of that. I think my point about the growth of the entrepreneurial culture. I think there's people take a much more nuanced and intelligent view these days, is my view.
I just think we need more optimism. I think going back to your earlier point, we're so realistic. We see the downside, but I think you need optimism, and I think that's what drives entrepreneurs. I think entrepreneurs see the risks completely differently to a lot of people, and how you can then turn the risk into opportunity. And one of the things I'm fascinated about, I think Steve Jobs had this thing called the reality distortion field, where he just basically tried to convince his teams that things that were otherwise unachievable were achievable, and was a complete nightmare to work with in trying to get them to do what was perceived to be unachievable. And in the end, he did it. And I think you need, as we come out of the crisis, and a lot of people have been bet, we need optimism, because without optimism, that psychological state, you're not going to get people just trying to do something that is outside of the norm, and that which is what can turn risk into opportunity. And that's what we need more of.
Can I just come in on that? Can you hear me? My mic working? I'm assuming it is. On the point around kind of taking risks, I mean, and just picking up what you said on Apple, kind of Google's perspective is very much take audacious risks, be hugely ambitious what you're trying to do, rather than try to make an incremental change, go for a big change. And it's better to fail at that big change than succeed in the incremental one, on the basis that at some point one of those big bets will come off. And that kind of culture is embedded throughout the company, down to the level of, we have key performance indicators like most large corporates. But what's different about our key performance indicators is you should never achieve them in a way. Your key performance indicators should be set so high that you actually kind of, you might achieve some of them, but if you achieve them all, you didn't set them high enough. And it's that kind of thinking all the way through that really reach high, but be prepared to fail, but then fail fast and learn fast from the failures. And I think, how do we change that culture? And part of it is about optimism. I think part of it is just about enabling people to become an entrepreneur more easily, whether it's selling something on eBay or starting the next Google.
Okay. I'm going to squeeze in 3 final questions, if we can keep them brief. Start with John.
John Mathmel from Ed Miliband's office. I'm going to resist the temptation, Chris, to answer your first question about what we'd like to see in the budget next week. Takes us down a whole different path. But on financing innovation, one of the things our business team have been looking at is a British investment bank. And that's not necessarily the simplistic, just use RBS and force them to invest in other schemes, but models like, I'm thinking the SBIC scheme in the US, where government provides some initial funding and then some guarantees, but the actual investing is then done by a string of private sector companies. And I'd just be interested in the panel's views on whether something that kind of model might work in the UK.
That's a good quick thought on that. I think the SBIC model is quite interesting. You've already got that, I think, introduced in your government for the enterprise capital funds, but writ large. I like the idea of having some kind of government leverage or government subsidy, but one of the two I think is quite interesting. As long as it's kept, as long as I think it's invested by the private sector, that's the important thing. And subject to normal market forces is the key.
Gentleman with the
Sure. Yes, I'm Brett Amflett from the Builders Merchants Federation, and as Sam has alluded to, we are a major supply chain and we are already bankers to the trade in construction. As we come to the end of this morning, I wonder, could we perhaps conclude with getting from the panel what their number one tip-top thing they want from the budget next week. If you're asking me what mine is, it's 5% VAT on home improvements, but I would like to hear from the panel, as we come to an end, what is their single number one? So if we were to meet a week from now, we could judge how successful we've been.
Okay, well, let me take one more question and give the panel a moment to think about that. So, the gentleman in the pink shirt.
Thank you. I'm Ben from Wonga. I welcome the general acknowledgement that there's an inertia amongst the high street retail banks in terms of their lending to small businesses. So that's just a comment. But Wonga is a successful business because of its use of huge masses of publicly available data. And building on Policy Exchange's report last week, does the panel agree that there are a number of other innovative businesses that would welcome the release of more publicly available data? Would they join me in calling on government to do so?
Yeah.
Yeah, and I think to be fair to the government, I think they get it on open data, and I think lots of things that we're seeing are moving in the right direction, and I think more and more government data is becoming available. I think the difficulty is how do you practically get it out there, and there are costs involved in that. But clearly, I think they recognise that there are returns that would come from getting that out there. I think where it starts to run into more difficulties is when you get into the area of those kind of quangos and those bodies that are at arm's length from government, which often have really valuable data, which government has no power over pushing out into the world. So we've been particularly slow in this country on releasing something simple as real-time train data, and the government aren't able to force that out into the open. And so we don't have the kind of simple apps that you have in other countries which just tell you exactly how late your train is going to be in the morning. But I think the government do get it, and I think they're moving in the right direction.
So I'm afraid it's time to draw this to a close. If the panel would like to offer in one sentence the thing they would like in the budget, then I'll give the opportunity now.
Execute on what you've already announced, and no surprises for wealth creators.
Am I allowed a longer sentence?
Yeah.
Debt is the excessive debt. Excessive leverage is the root cause of every major crisis in the last 300 years of capitalist history. So we'd like to see a reduction in the subsidization of debt. And we would like to see a decrease in the weight of fiscal pressure on equities.
The campaign I've been running for the last year is Beyond the Banks. So understandably, what I would like to see from the budget in terms of the breeding review, I think, which comes out tomorrow, and also the business finance partnership, where £1 billion is going to be supporting non-bank institutions. I would like to see the government back in a lot of those innovative, disruptive businesses that are out there providing finance to real businesses in the economy. I think, yes, the banks have a role, but I think we've got to create a new landscape, and I want to see the Treasury coming out and backing those organisations.
I would say we have copyright laws that are made for tape recorders, and we need to modernise those, so I'd like to see a commitment to see through the Hargreaves proposals.
Finally, encouraging institutions to invest in venture capital.
Okay, well, this has made my summing up very easy. So a couple of final words from me. I mentioned the Policy Exchange report, Financing Innovation, which if you'd like to read more about our take on some of these issues, you can retrieve from the website. And I'd just like to thank our sponsors. This event is part of a wider programme of work here at Policy Exchange on innovation, the digital economy and growth, and we are very grateful to Google, the London Stock Exchange Group, and the British Stock Association for their support and encouragement. And finally, thank you to our speakers. It's been an excellent session.